Hello, everyone, and welcome back. Once again, we're back with the KoreSummit Blockchain Summit. Today, we have a doozy of a topic. Like always, we try to make it exciting, educational, as always. It's great to have myself, Oscar Jofre, and Dr. Kiran Garimella. We do have a guest today, so we're going to wait to introduce him to everyone. But before we get started, I just want to thank our sponsors. Without their support, the private capital markets would not be evolving as it is, but more importantly, they're supporting these initiatives of education. Want a shout out to Nuvei, who has been a strong supporter providing payment rails for the private capital markets. And I know that may seem simple for everybody. It's easy. It's not. Trust me, it is not. Selling securities over the internet does bring some interesting challenges. Thank you, Nuvei. And of course, KoreChain, the first blockchain company that's gone through the qualification process with the SEC, which is an important milestone for every blockchain company to achieve. So today we are going to have an interesting topic, and it relates to everything that we've been talking to for the last few weeks. So, some people send me, Oscar, what does K1's and blockchain have in common? And I'm going, well, all of you guys keep talking about tokenization real estate, and you keep forgetting the one element that these companies are going to deal with. So today we're going to be talking about K1's and blockchain. Blockchain is, it's going to sit on underneath it all. So it's important to understand what K1's are. And Kiran and I had the pleasure of meeting our next guest in New York. And I have to tell you, since that day, my brain has been, I don't know, it became mush. It became mush. Whatever I thought I knew, it went out the door that day. And I was thinking of our clients immediately. Oh, my goodness. And because of Matthew's guidance, a lot of them are already shifting, which is great. So, Matthew, if you could please take a moment to introduce yourself to everyone here today, that'd be wonderful. And then we are going to dive in to K1's.
How's it going, everybody? I'm Matthew John McNally. I'm the managing partner of Evolved.
Did we get done?
Yeah.
You gotta let. Oh, sorry. You know what? Thank you. You're not like like Kiran. I'm Dr. Kiran Garimella. I published 17 books. I got 17 papers. And I spent 25 years. I appreciate it. Short and sweet. Hey, you gotta love that. Caught me way off guard though. I thought there was a. All right, let's get started. All right. So as I said, as we were starting, this was going to be related to everything we've been talking about. So I'm just going to circle it back for everyone really quickly, so we got a context in what we're talking about. So everything we're reading about everywhere out there is tokenization, and the number one asset class, real world asset that everybody's going after is real estate. And and that brought up an interesting topic that Kiran and I, like I said, we were in New York. We met with Matt and his partner to, learn a little bit more about K1's, and we felt that this was the time we needed to bring this out. I couldn't believe the amount of time that he spent with us and everything we learned. And more importantly, we think it's important for everybody else to understand, because again, people think that blockchain is going to solve the world, which is, to Matt, I don't think blockchain really matters, other than the reality of what it is. So we've talked about real estate, we talked about tokenization, we talked about you're raising capital, and now we're going to talk about the most common legal structure that is often seen in real estate, which is LLCs, where the K1's come in. And so first, before we go into K1, Matt, if you could take a moment, what is a K1? What is it? And why is it such a big topic, in particular within the real estate market?
So the K1 is basically the partner share of the partnership's 1065. So each partnership is required under federal law to file a partnership return, which is Form 1065, and you have to attach certain other schedules to it depending on what kind of business you're in. the K1s are just basically the 1065 broken out in detail to the partner so they can pick up the income on their tax return.
And if I understand correctly, and Kiran, step in, because I know that you've had experience with K1s.
Oh yeah. And I think some of the audience may have absolutely no idea what the intent behind all this is. That I've invested in partnerships and I've received K1s myself, so I kind of know that. But essentially, it is sort of the reporting of pass-through income from LLCs and S corporations. So there is no double taxation, something like that, right, Matt?
It's the partners or investors' share of the income for that year in the partnership, which is an LLC. So just to level set, an LLC is a partnership, filing, right? There's other right? So regardless if you're an LP, an LLP, or an LLC, you have to file a Form 1065. And then to relinquish your K1s from that 1065, giving their partners the share of their income on the actual form that they receive, that they will bring into their either business income to return or individual tax return.
Yeah. Hey, what's interesting, Matt? I mean, after our conversation, I was intrigued because I kept getting K1s and I never paid attention to them, just turned them over to my CPA to deal with. But, I was kind of reading up on this one, and it really struck me. It was amazing that even in the medieval times, there was a concept of a pass-through income. I mean, I found that really fascinating. Many times, we think we sort of invented some of these things in modern, finance. But it turns out way back in the medieval world, they had this concept of pass-through income, and but they didn't call it K1s. Obviously, K1s are a new invention from here. But I thought I'll just share that with folks, as a fun fact.
The schedule K1 comes out of the investors or partners' share of the Schedule K, which is part of the 1065. So it's just a breakout of that income. But there's significant different handling of income and investments on a 1065 when you compare whether you're an investment company versus a real estate company versus a trader business.
Are K1s basically just for is it only for US, or is it also for foreign investors, or the equivalents in other countries?
So if you're a foreign investor, you have to be relinquished a K1 regardless from the tax return. But they don't have to pick it up the same way. They have to deal with how their country that they're in deals with that income. And every country's different, just like every state's different.
Right. Okay.
So we're diving into the weeds of the K1, what it is, the history of it, which is an important element. And obviously, those involved in real estate have seen quite a bit of it, as you said, Kiran. You've seen it in return, but from obviously, Matt, you're the expert here, and obviously we want to get into detail, but at the same time, high level. What are the key components for a K1 when it comes to real estate partnerships that obviously we want the audience to understand the relevance of this? Because, as I said, a lot of people are just hey, we're going to tokenize in real estate, and you already know this, and even in traditional, people think of K1 as an afterthought, but we're going to get into all the different planning components to it, because otherwise you could have a massive problem at the end of the year, correct? I mean, when you need to issue these K1s, right?
Yeah, no. So you should really be getting, people like companies like my firm or your CPA involved in your planning very, very quickly after starting the business. You want to start to discuss what you're going to invest in, right? We'll start with who's going to invest in you, what you're going to invest in, and where it's going to be. Because all those different things have different aspects to them, and could cause major filings, could cause major issues. It could cause a rewrite of your agreements, depending on who wrote the agreements and how well they were written.
That's a great way to word it. So it isn't just so much about getting the investor. It's what are you putting the money into, and how and all of that. Those are all the components of the K1 reporting. That's interesting.
So who's investing in your firm, what you're investing in, and where you're investing, what state, what country. It's very important.
Wow. So those all tie into the K1, and then obviously, so companies that are going into real estate and planning this, and after, so knowing their investor, because we're not going to share the company name, but we were discussing, here's a client using these amazing regulations like Regulation CF or Regulation A+, and doing this kind of legal structure, not knowing the impact, because not only do you need to take care of understanding what the K1 is and all that, but you also need to take care of the fact of what are your ongoing, are they tax implications, or are they considered reporting obligations on behalf of the company?
It could be both. It could be
both.
You might have withholding obligation. Yeah.
And
if you're in one state and you have investors in another state, you might have to withhold on those investors.
Okay, so interesting, and when and of course, if the investor if the investors are coming from the United States, and if the investors are coming from outside of the United States, we run into a whole different dilemma, right?
Much bigger issues. There's treaty issues with the United States. So Canada has a treaty, of course, with the United States. Most countries do, but they are very specific to that country. So one country will say, oh, your withholding has to be at 10%, and another country you'll have to do 30%. So it's very important who your investors are.
So yeah, no, sorry, just a quick question. So I remember receiving K1s. I mean, I'm in the US citizen. I'm here in the United States. And I remember receiving K1s, and sometimes it's a very small amounts. I mean, sometimes it's not a whole lot, it's small amount. So I have to believe that in many cases it's not a cost-effective thing for a company. I mean, are there some implications for all this? I mean, sometimes you might see a K1. I remember there was some obscure company that I had from many years ago, and it just gave me a K1 for like $1.50 or something, and I'm saying, oh my gosh, they went through this entire thing to generate this one. What's the dynamics behind that, Matt?
It's very expensive when what I like to always tell people is the difference between an LLC and a corp. The corp is very less administratively intensive when it comes to your investors. With an LLC, every year you have to provide a K1 to that investor. That gets, expense-wise, that can get very expensive, especially if you're a fund. If you're doing a fund with a ton of investors in it, let's say you're doing 500 investors, you're going to pay somewhere between $10 to $25 per K1 for those investors. So that adds up very quickly. You have 1,000 investors, and even if it's $15, it's a lot of money, $15,000 right off the bat of just your compliance expenses. And then
and those are only the ones in the United States, right, Matt? I mean, one of the examples you gave us is when you start doing the foreign element, that cost goes up dramatically as well, right?
Yeah, and there's a lot of ramifications that the foreign people won't understand or know. So, one thing is foreign withholding, which means that we would have to withhold a certain percentage of your money, and then you'll have to file a U.S. tax return. And if you've never done that before, you're going to have to pay for that and to find somebody to do it. It's not always easy. But some of the bigger issues comes down to actually more of the state issues in the United States alone are some of the bigger concerns.
Yeah, let's cover those. I mean, you mentioned that there is a number of states that I was shocked. Nothing shocks me anymore, but where if you mentioned, let's take New Jersey for instance, because there's 8 of them, right? There's 8 states.
Let me just back it a little bit. So
sure.
when you're dealing with any sort of filing, right? You have in the United States, you have the federal government, right? And then you have each state government, and there's 50 of them. So New York is very different than Alabama. Alabama is different than Texas, and they all have different rules about filing requirements and who has to file and why they have to file. There's only about 3 or 4 states that don't have a partnership filing requirement, but the rest do, and some of them get very hefty, depending on what you're doing in that state. So one of the things is that if you're doing business in a state, right? So let's just talk first about, take a step back again, talk about nexus, right? Do you have to file in that state, and what determines this nexus, right? So if you're in a real estate, investing in real estate in Arizona, you're going to have to file a federal tax return and an Arizona tax return.
Wow.
Right. And Arizona has K1's and the federal have K1's, right? And depending on how many partners you have, that's now more expense for you. So now you're talking where maybe the federal would be $10 a K1. Now we're talking about $15 because now you added a state.
And all of those have to be delivered to the investor as well.
Other ramifications when it comes to what state you're in. Correct.
Yeah. So there's
also, when you're writing your agreements, it's go ahead. So when you're writing your agreements, it's very important that you understand that this is very time intensive, and giving them a date that you're going to give them their tax information being 3/31 or February is very tight and a hard turnaround. So you have to think about the administrative burden of getting all your books and records done, your K1's done by a certain date. So I always expect that people, especially in the real estate, especially trader business, that you expand those timelines out maybe until May, and tell the people you're just going to have to put your return on extension until you receive the K1.
Yeah, I ran into that situation, Matt. I mean, I thought there was an obligation for companies to send that, because the K1s actually affect your personal taxes, right? I mean, so you have to file your personal taxes, and if you don't get the K1s on time, like you do the W2s and others, right? Then you have to, So there was a situation where I had to, I received a K1, right before or after, the like March 31st, and we didn't have enough time to turn around, so I had to end up filing an extension. For that. And sometimes, if there's a CPA involved in that, man, that can get sort of expensive, right? Because now they have to file an extension, then redo everything a little bit later. Yeah, so that can be a problem. But let me ask you one thing. So, we are looking at, situations where, the real estate market is like really big, right? I mean, the commercial real estate investments and so on. Isn't that one of the prime candidates for these K1s? I mean, do you see a lot of volume from those types of companies in that industry?
Honestly, my opinion is unless your investors are all giving you 25K or more, I would not do an LLC. Regardless, it's just a bigger administrative burden. Some of the bigger issues when it comes to general expenses also. If you're in a corp, you're not going to get any sort of income until there's a dividend. But every year, you're going to get a K1. And, I always joke with people and say, once your CPA sees that you get K1, your fee is going to go up definitely by 20%. Just because now they think that, oh, look, this guy's, big time. And it is a bunch of extra work, and the timing of it. So then if they have to put you on extension, that's more money. And then, depending out on how much details on the K1, which could get hairy, it could run you a lot of money on the investor side. And then that's not even talking about the actual entity that owns the property expenses.
And Matt, can I know the audience this time, you feel like Kiran and I are like bouncing questions because my brain has been buzzing since the day we left. And it's something that, we were in town, Kiran and I, for another coalition. And the remark I made, I said, Matt, here is a room full of lawyers. Here's a room full of technologists. And we're talking about something that's going to affect accounting and not a single accounting firm.
Yeah.
And so why is it that companies are obviously every real estate deal that I see goes in, hey, I want to do an LLC right away. That's what my lawyer recommend. Where's the accountant in this discussion? Why are they not the first one in this discussion? So the company, because we're dealing with that right now, you and I, where the companies at the tail end of it saying, "Oh my God, we walked into a landmine," right? Where is that?
I have no idea. Usually, I guess the lawyer usually tells people that they understand this stuff, and they usually do. They just don't understand the overall compliance ramifications of it. They understand, you might have to file here, you might have to file there, but the breadth of it is very regularly not understood by the lawyers. And I think accountants give clearer pictures on that stuff, and that's why they should be in the room.
Actually, wow. I like that. You're right. I think we all make that. We say, "Hey, don't worry. You just got to do a couple of filings and all that," and then you go see Matt. No, it's not a couple of filings. It's a couple of filing, one for federal, state, and then for foreign investors. So that's the reason why we get. Sorry, Kiran.
No, yeah. No, I didn't mean to interrupt. But on that note, right? Matt, what is your feeling on how much people actually understand? And I know the accountants probably do, obviously, right? But others, do they really understand that there are various types of K1s? I mean, you've got partnerships, you've got S corporations, you've got trusts and estates, and some of them may also need to file. But aren't all those forms somewhat different?
Every one of them is different, and depending on what you're actually investing in, right? So what I spoke about before, I spoke trade or business, investment, or real estate. There's all different ramifications of what those investments curtail to the actual partners. People like using LLCs because they get a piece of the company and they get to take deductions, but it only benefits them if they have, because they're not active in the partnership. They only get benefits if they have other investments. But people rarely explain it to them. You can't, if you're not active in a partnership, you can't take losses on that partnership until you have income to offset it by.
Right. And there's also situations where the company, like a REIT, for example, if they're selling properties in midstream and refinancing others and merging stuff or creating, there's a lot of corporate activity that goes on, right? And some of that needs to be conveyed to the investors. So there's an obligation. Isn't there an obligation that they need to convey to the investors? And how is all of that reflected in K1, or should it be point in time? So whenever there's a material change in a property where it's been refinanced or done at that point in time or immediately thereafter, are the investors supposed to be notified that this happened, or does all of that get bundled into the K1 at the end of the year?
Well, actually, the K1 is usually just income based, right? Your allocation of the income. Any sort of detail like you're speaking of reinvestment and things that are in the actual partnership agreement that you have, really should be discussed more in the yearly cap statements that you provide to the partner. So there's two things you should provide to each partner every year. Is their general cap statement, and then their K1s. The cap statement is where I would put any activity for the partnership, like the things that you discussed in that discussing what went on throughout the year, and here's your your beginning capital and your ending capital. The tax comes a little bit later, and it's a little different, but that's usually only numbers and detail based in tax accounting, essentially.
Right. Okay.
It gets complicated, Kiran, the more I think about it. I mean, the more that I understand about K1s, we throw it out, we tell people, yeah, we do K1s. Well, we don't do them. We don't process them. We deliver them. So I'll be, but it gets thrown out. And now that I have such a, not in a full understanding of it, but so why we're bringing this into blockchain is because, as I said right from the beginning, everybody's talking about it, but nobody's talking about the after effect. And then you try to bring it up and think, oh, don't worry, our lawyer already took care of it. But as you are experiencing, we're doing it with clients right now, is that when that moment comes, it becomes a huge bill, which is twice, three, four, five. It can be huge if it's not properly planned. If there's any particular time where you need to really think about your strategy, how to use this particular legal structure, is really imperative, because otherwise you're really moving your company into a downward spiral where you're going to need to shut it down and investors' monies will get lost. I mean, this is it. This is just my overview of what I'm looking at. And I've often, that's why I keep asking, why is this person not involved in the early discussions? Because up until now, look, we see a lot of companies doing LLCs and Reg As, right? We're seeing that. And where they're taking minimum investments from investors. And I haven't gone back to them and said, hey, are you aware of this, and that yet? And we haven't, because obviously this is part of the journey of learning K1's in its fullness. And so I'm wondering, Matt, I mean, from your experience, obviously we all agree that you need to be there, and people, for whatever reason, you just said it, I think you said it best. Lawyers understand that it's needed. What they do not understand is the wrath of what is needed. Did I get it correctly? Like they know there's a filing, they just don't know.
The complexity. Yeah.
Okay.
Yeah, you
So
also like one of the best things having your account in the beginning is that they can help you with controls and to understand how you should be setting up your books. If you have a multi-entity structure, they can they can break out you like, oh, every structure, every entity in that structure technically has to have their own set of books and records, even though maybe at the end you're combining them, they still need to be tracking them per entity. Why we're generally not in the room. People try to cut down. The lawyer is very expensive, and the lawyer is very good. They know their jobs, but they just don't know the level of burden that it's going to put on you, and and clearly breaking out some very detailed information about like what states you're investing in is important.
Yeah, it's the operational element of that they may not appreciate, right? They may just know something needs to be done, but what it actually takes to get it done. I mean, that's the challenge, right?
I've had lawyers call it a mail merge to my face. It's just a mail merge.
It's just a mail merge.
Yeah,
yeah,
okay.
I know.
Well, then you do it.
Exactly.
It's
like having a launch shuttle on. Okay, what do you do to launch it? Well, just simply ignite the dang thing. That's it, right? It's going to take off. It's not that easy. Can I ask? There's something that's intriguing me, Matt, and I'd like your opinion on this one. So, I'm an investor, so I've traded and invested in many types of instruments myself. But when I was following the things, I mean, there's all kinds of how do you value a company? How do you determine what the company is doing? And there are people who do detailed analysis of balance sheets and cash flow statements and insider trading and all these things, right? I've heard somewhere, and you correct me if I'm wrong. So the K1's, right? Just the K1's. So as an investor, if I'm receiving the K1's, the most obvious thing that people know in the space is that, oh, I need a K1 for tax filing, right? It's part of that tax annual ritual that we go through. But I've also heard, and I would like your opinion on this one, aren't K1s also a very important financial detective tool for investors to analyze a little bit more in depth how the company is doing? And so that's one part. And then the other part is that it also has implications for estate planning through trusts, right? And I don't know if there's enough spotlight on some of those secondary use cases of K1. So we kind of would love your color commentary on that one.
I don't know how much you can actually tell the business is doing well by looking at a K1, unless you understand the tax, some of the tax issues on there to say, last year's income was a lot less, but this year it's more. I don't know if that's a predictor of more success or a predictor of that a certain deduction is no longer being taken. So yeah, it's what you should get every year is you most of the time as part of the partnership agreement, you have a right to see the financial statements. So I would just request those to see, the activity of the company and what they're talking about.
Yeah, yeah. But certainly, large investors, they should be concerned about, not just the tax implications, but also the secondary ones where they can say, hey, wait a minute, it may have a bearing on my estate planning strategies, right?
I mean, there's multiple issues they should worry about. A lot of it, they might have a huge amount of income that they didn't know they were getting. They probably didn't pay their estimated payments enough. So not getting them some sort of estimated amount that they're going to have to pick up at the beginning of the year could really damage them. They could be, all of a sudden you say to them, hey, here's $500,000 of income you didn't know you have. They're going to pay penalties on that, right? If they didn't have enough estimated tax paid in, they're going to be hurt, and they're going to be, looking for, retribution from you if they have to pay, $20,000 in penalties to the IRS.
Jesus.
Yeah.
I mean, it's a
So
big item.
so that penalty would have to be handled by the company. It
would be the individual. So as an individual, you have to do your estimated taxes for the year, right?
Yeah,
so if you estimate that you're going to have a certain amount of income and that's what you're paying based on, and all of a sudden you get a K1 that's $500,000 more, you're going to get hit with penalties for not doing your estimated tax properly. And there's I don't want to get too hairy to the details. There's all things about what percentage you have paid in prior to last year, but it could be a very expensive lesson for you.
So do you recall when we were sitting down and I go, as much as I was shocked, the reason why Kiran and we were in New York for another shocking experience of, everybody keeps thinking that we're the whole world is, oh yeah, we're all up to date, we got standards and all that. And here, Kiran, we attended an event of the top players in managing cap table without the accountants, so we won't discuss that today, only to find out that after 4 years they've only figured out a standard to move securities for venture back, which is great. This is fantastic. What I was surprised by that, and it wasn't so shocking when you shared with me, I go, how big of an issue is K1's today? And you said it's still going on, and I'm wondering where is the neglect? Where is it? Because we want to obviously educate the market. We want to create not a warning. That's not what we're trying to do. We want to preempt hey, if we can assist the issuer down the journey, because look, once you start using blockchain, you start putting all this. This is that whole component of immutability, right?
That's right.
You can't just. But the other part is that all these things are great, and we're going to do K1's. Like I was on a call with a group of people. Yeah, we want to do this, and you want to do everything. But the reality is, if you haven't done it, you really do not understand the consequences. So circle back at me. Let's go from the beginning. We now know we know what the company needs to do from a K1. We know the legal structures. We know the implication for the investors and all that. And of course, I hope everybody heard what Matt said is, we have some issues here that they need to account for. And when the lawyer says, yeah, don't worry, you got some filings, dig deeper. What are those filings? But let me ask you this. What are the tips that need to be handed down to a company right from the beginning when all this being formulated? What are the things that they need to keep asking themselves? I know you started that at the beginning, but let's walk through it in more detail. And then when they make those choices, are you able to provide an anticipated, okay, you go down this path, it's going to be X, and because of X, you need to do Y. So can we go through that? Because I think I want to move into the section of, okay, now we know what it is, who it's affecting, how do we prevent this going forward?
Yeah, so I like to use the old who, what, where. Who's investing in your fund, U.S. person or foreign person, right? U.S. Then you want to say what type of entity, right? Because the type of entity is important, because some entities, other flow throughs. And again, reiterate this 100 times. This all depends on what state you're investing in, right? But it's U.S. or foreign. Accepting foreign people is a lot more administrative burden. And what type of entity is not so much of a burden. It's just how they have to be treated for different states and the federal. What are you, right? Are you a trade of business? Are you investment income, or are you real estate? And one thing I want to go back to Kiran, he did happen to mention REITs before. We just want to point out that when he says REITs, that's a real estate it's not a REIT as in an actual REIT. It's just a REIT-like structure, different from an actual REIT. And then where are you investing? So if you're investing in the U.S. and what state are you investing in? How many states are you investing in? And one of the great things I always love when you talk to some of these new people starting a fund is that they always go, well, let's just set it up that we do in every state. And it's like, whoa, no. Like that's mega money. That's, you have state filing requirements for property or businesses that you own in that state. You have payroll requirements for states. If you're hiring somebody in Colorado and your business is in Arizona, you're going to pay payroll in Colorado, and you have to file to do that. And every state has that. So every state you have to file with the Secretary of State if you're doing business there, or if you have employees there or property there, and then you have to file returns. Those issues then turn into, now you might possibly have to do a nexus study to see if you have nexus in those states, and then that tells you why and where you have to file.
That's very, and it's so it's interesting. You said just copy it into the other states, and that immediately should be the no. So who should be the one providing? Obviously, like I said, they're not getting to you or anybody with this kind of experience at the time of creation. It's always been done after the fact, which often costs even more money, which, you got to do twice the work, right? You got to undo the deal and so on. So where should be the setup? Like, I'll give you an example. Today, we tell issuers, okay, you want to do this regulation, you need A, B, C, D, E, F, G. We're not saying we're doing it. Just here's the things you need to be asking. So in this model for real estate, it's not just, hey, I'm going to be the sponsor for a $50 million project. I'm going to use LLC. Now you got to start going through these checklist items. Is it the lawyer that should be presented with this in order to be educated in advance? Or is it both? Or is the lawyer going to be the showstopper and say, no, don't worry about it, we can just move forward, and then the issuer needs to deal with it after the fact? I'm just curious because, as you said, the problem's still going on, and I'm the type of person that likes to plug in where the problem is, right?
Yeah. I don't like to bash lawyers, but lawyers usually get paid their hourly rate and then they're gone. The ramifications of what they suggested is something you're going to have to deal with, and they're just going to say, well, we mentioned it, but we didn't know, that the ramifications were that big. And one of the examples I always like to use is if you're doing an LLC, there are I believe it's 8 states that require you to file if you have an investor in that state. So, right. So somebody who's getting a K1 lives in Indiana, right? But now you're, and you have 500 other investors. None of them live in Indiana. Well, guess what? Every person is getting an Indiana K1 because of that one investor.
Oh my goodness!
So wait a minute. So even if I'm living in Florida, I get a K1 because of that one person in Indiana.
Correct. And some states are, they're very lackadaisical on like their penalties if you don't file, right? So like, I'll give you, it's Indiana, Georgia, and I might miss some of these, New Jersey, New York, Florida, and I can send you guys a list of the other ones as well. We actually have a breakdown of it. But some of the states are tougher than others. So when it comes to Indiana is what we call a high penalty state, which means if you don't file an Indiana tax return and they catch you, for every partner in the fund, it's $250 for not filing. So if they catch you and you have 500 partners, the penalty is that large. But then you have Georgia that says, oh, if you don't file, I think it's $10 a partner or some minimal amount. The biggest and most scariest one is New Jersey. So if you have property in New Jersey, now investment property and actual like property, actually trader business is different. But if you have a trader business in New Jersey, you have to file and pay $150 per partner, regardless of where they live in New Jersey. So 1,000 partners is $15,000 a year just because you have a trader business in New Jersey.
Unbelievable. And that's the company paying that. It's not the individual investor or member. I'm sorry?
That's the company paying that.
Oh, the company paying it. Okay.
Responsibility, yeah.
It's still a huge burden, right? I mean, it's still huge. Wow. And obviously the investors are going to be stuck with the after effects of that, because now the K1s come through, they have to refile or amend their tax return as well.
Yeah, and if you're a $1,000 investor and 2 years is $300, that's 30% of the investment already gone right off the bat. So it's very key to look at those things. There's some other high penalty states out there that it's just not worth getting caught not filing as well. So you file, but every additional, because my team has to go and look at a federal K1, then they have to look at the states, make sure it's being allocated correctly, and there's really nothing on like an Indiana return to allocate to anybody just because you have one investor. But we still have to look at it, we still have to review it, and you still have to file a tax return, and that costs money.
Unreal. I mean, if you just had one investor in Indiana, one in New Jersey, I mean, there goes your business right there.
Yeah. And then you think about then it becomes also an administrative burden, because you're going to have let's just say if you have 5% of your people coming back and asking questions on why did I get an Indiana tax return?
Of course,
you're going to be on the phone for 3 weeks.
Oh, no kidding. Absolutely. Wow. No, that's a
investment relations
nightmare.
Yeah, investor relations is just an important part of your business as anything else. And if you have to pay somebody to explain all this stuff to them, and if you think, oh, well, just send a letter out, nobody reads them. So, right, they're still going to call. So
we know that's not enough. People will still call. You're 100% right.
You can list out every single thing to somebody, and they don't want to read it. They're going to call you. So
and worse is they'll debate with you. They'll say, no, that's wrong. You shouldn't be. And yeah, you're right. Absolutely.
And you technically, as the investor advisor, can't really give tax advice to them, or so you're kind of stuck in between. So then what are you going to do? Have pay somebody like me to talk to them? I'm not cheap.
No, and it's not even the fact that whether you're cheap or expensive. All of this, everything, as I hear you speak, and I've been hearing you speak since we left your office that Friday, is that it's all preventable. I mean, this is not one that you're walking into a sandbag and I don't know what's going to happen. Let's just keep walking. That was the blockchain crypto world. You kind of had to walk and make sure. But on this one, you already know what the issue is, and there's no way around it. And that's why it's just kind of shocking to me that it's still a problem, and companies find out at a later time. And part of that is that, and what is even more shocking, that investors do not know to ask these particular questions when they're making investments in companies like this. Are you prepared, to issue K1? Well, let me ask you this, Matt. I mean, so now that we've seen it, how a company can make a mistake, how does an investor protect itself when they see an opportunity that's going to be issuing dividends because it's an LLC and all that? What kind of questions should they be asking the company to make sure that at least it wakes the company up and say, hey, you know what? Jesus, that's a good question. And this way it could prevent, some hazardous path for them on this investment, because it could go down the drain. As you just said, they spend They get $1,000 investment and $700 is gone just in filings.
Yeah, I mean, they should be, asking them, like, because I think all the investments should be very, drawn down to like specific investments. So I'd be asking where you're investing. Is there administrative burden on the firm for the investments that you're doing? Is there a way to segregate out the investments so that we're only in certain investments? So maybe somebody doesn't want to be in or have to file a tax return in Arizona if the property is owned in Arizona, but they're going to have to. So me as a New York person, when I was a partner in a partnership that filed a tax return in Illinois, I had to file an individual tax return in Illinois. So the person has to now. There's arguments to be said that if you're that one guy in Indiana who, right, I don't think, or you don't really have to file the Indiana tax return if there's no sourced income on there, but you still are getting the Indiana K1. Only the guy in Indiana has to file Indiana K1. Now, if there's the bigger issues is if there's sourced income to a state, right? So I like to go back to Arizona. Sourced income to Arizona means that you're, Oscar, if you have an investment that's in Arizona that's giving out sourced, right, effectively connected income to that state, you're filing an individual tax return in Arizona. And the company would also have to withhold, depending on the state rules, right? And I'm just using Arizona as a name, but depending on the state rules, there's withholding requirements for out-of-state people. So if you have your business, the trader businesses in Arizona, and then you have 500 people and only 10% of them, 50 of them are in Arizona. Well, guess what? All 500 are filing Arizona tax returns because they have sourced income on that return.
Oh, it's unbelievable. It's
and it's going to take the money's going to come out of your investment. So the only way you get it back is to file a tax return in Arizona and say, "Give me my money back." But then I'm going to charge you as your accountant more money because that's another state return. So it's beneficial that they know where the source of the income is coming from, and what the burden is going to be to them.
And it's rather interesting the way you describe it, because you're right. When you go to lawyer, oh yeah, you're not going to do anything. Just put it on LLC, and no afterthought is put into it, and you follow legal advice and you move forward. When in reality, you should be putting this in a legal structure that makes better sense for you as a company, rather than without having a full understanding what's on the tail end. And since that conversation, I have not been able to shake it off, and I almost feel like I know you create a checklist, and I see your blogs, and we're all educating, and I'm always trying to figure out what is not getting across the line to provide that element. Is it, sometimes I do things in buckets. Okay, so investors, when investing in company K1, here's the questions you ask, 3, 4, and that's it, and just put that out there. For issuers, the companies thinking of using the structure, these are the 5 things you need to. And then for the lawyers, just, hey, a quick reminder, because because there's a shift occurring where companies are moving into a Reg A LLC. So when you're doing a Reg D where you got 50 investors to put in $30 million, okay, you go, yeah, that's fine. I don't mind the filing fees.
Yeah.
Okay, how about 3,000 investors? That changes the fee structure dramatically. 30 investors, 3,000.
Just on the odds alone, 3,000 investors are going to be in probably 50 states, right? 50 investors, the odds of being in 50 states is rare, right? But 3,000, you're just inching it up towards more and more states, and that puts you into the category of having to file 8 additional tax returns.
Wow. And again, the importance of making sure that we're being compliant. And this is I'm glad we had this conversation, because it's now that we're everybody's talking about the big opportunity in the market right now. There are many companies out there that are focusing on real estate tokenization, and which is great. This is not indicating that tokenization isn't going to work or anything like that. But before any company steps in, everybody should kind of give the company a heads up, because otherwise you're just walking them down a path where they're raising capital under this kind of environment where, like, we're dealing with right now, which, it's not that we're taking responsibility. We weren't the lawyer or the auditor, but Matt and ourselves are the ones dealing with the effect of the client with their anger, right? They're angry, and they should be, right?
Yeah, well, I had a client come to me and say, we need K1's by next week. And I was like, that's not happening.
That's right, exactly.
That's another point. It's sort of like, yeah, I just go to the grocery store and just get it. Oh no, because again, the lack of understanding what these things are, and then they put all this unbound pressure on everyone in making this thing happen. So again, everyone, if you want to meet Matt, you can go to KoreSummit.com. His bio's there. He's on LinkedIn. You can reach out to us. We will provide you so you can reach out to his firm.
I just want to give a real quick list of the
Yes.
resident filing states, because I didn't give a full list before, but I just pulled.
Oh, yes, please.
So Georgia, Indiana, Missouri, New Jersey, Oregon, Pennsylvania, and West Virginia.
So everybody write down those states. That's the thank you for that. Well, it's interesting, we're in Reg A, people, I don't need a broker dealer. Yes, but there are 7 you have to watch out for. And
exactly.
And it's when you're bringing in money, you're not paying too much attention to the states sometimes. So it's always best to, the same way that we always make sure that there's a FINRA broker dealer to make sure that you can do it. It's important that people reach out to Matt. And thank you again. And I know, Matt, we only scratched the surface today. I know that. I know that what I'd like to do next time is we'll probably have a session where we actually bring a case study, like deal without obviously disclosing the name of the firm, because I think that's important. But so people can see, holy macro, this is what they filed. This is what happened. This is how many holders they had. This was the issue. And this is what EvolvedX ended up doing to help the client out in order to undo this. And then the big thing is, how could this been prevented? And again, this is it's preventable, right? Preventable just by putting those things together. So
it's not preventable, because if you have partners, you have a partner in Indiana and you want their money, or can you say, oh, we don't take partners from Indiana? No, but it's better that you just know what you're getting yourself into.
And that's, you know what? That's a great point. It's not an issue of whether you won't take the funds or anything like that, but at least you should go in with your eyes wide open and prepared and managing it. We all manage risk every day. This is not to anybody involved in real estate that are doing that. We're all doing it, but at least you're coming in with your eyes wide open. And there's a lot of people coming into this space that are very new to real estate. And they're, they know some parts of it, this part, but they may not all know all the little intricacies. And as we open it up, I mean, it's just providing that education. Education helps you understand the risk. If it means that it can prevented you from going down this road and you didn't want to, then it did help. But if you didn't know and you can manage it, hey, even better, right?
Yeah, and every state has different intricacies. So like you need to, understand that from each state. Some states have, other filing requirements that might cost you money as well. So if you if you're giving out if you own property here, in New York City, if you rent and your rent is over, I think $250,000, you have to pay a rent tax. So it's good. It's important to know all the different state rules, and unfortunately, the bluer the state, most likely the larger the rules. So you can keep that in mind.
And that's the other thing, right? I mean, people say, is it preventable? Can I do something differently to avoid all this? Can I form a C corporation instead? And in the comments, you can see some of these, can we Can a partner from Indiana set up a company, like in a different state and invest through that state? But every one of these has its own disadvantages and additional expenses as well, right? I mean, that's unavoidable.
Yeah, I mean, a corp is less administrative burden, but you still have filing requirements.
Yeah.
You don't have the residency filing requirements, but you still have other filing requirements. Corps pay tax, so you can't give out. You're gonna have to give out dividends. Those dividends are taxed. It's double taxation. So it's just knowing those sort of things too. So
yeah. It's and I know we're kind of running out of time, and we had positioned this as a K1's in the blockchain world, right? I mean, where does blockchain play into all this? And I mean, I think the approach. I mean, we in our team, we come from the compliance space and finance world ourselves, and I think the main point, at least I want to make here, is it's important to understand the business first and the process and all the regulations. I mean, it's important to talk to experts like you first before we think about solutions, because what I see in the DeFi space, the decentralized finance space, is that people approach it from the other side. They say, oh yeah, no problem, we'll write a smart contract for this one, we'll do this, it's a protocol, yeah, get a K1, right? It doesn't happen that easily, right? And thankfully, because of our background, right, one of the provisions we make is that hey, let's make sure we have a regulatory framework. We're actually capturing all these various rules. We have done that with Blue Sky laws. We've done that with many other jurisdictions, and where it applies in foreign countries as well. And we have smart contracts, that can at least track these things. But automatically issuing K1s and all, I mean, that's a stretch, because the underlying mechanics, administrative mechanics of doing this are so varied. There are so many ways, and that's kind of where we have to if people have to consult the experts like you. I mean, that's the key, right?
Yeah, and honestly, there's another sort of element I didn't even mention that just popped in my head. Don't forget that I'm a tax guy, right? If somebody's not in your organization doing the book work and knows how to properly break up the book work, you need to get an accountant to talk to them about that, because I can't do anything with tax until your books are done.
Yeah. No, fair point.
It is amazing. This topic brings up such interesting questions from everyone regarding the issue, and part of it is that I know we can't in 1 hour cover each session. I'm almost thinking, Kiran, is that there's almost got to be an entire education for investors in understanding what a K1 is, because I you said something really interesting, that you would get them and you just kind of like file them or give them to your account, but they weren't just that. So that was one element. But and what happens when you're receiving so many other pieces of paper? Why is that? Then, as Matt said, depending on what states they're in, there's going to be additional. And then, of course, what kind of questions should investors be asking when that is going to be offered, to make sure that they know that the party at the other side. I think this is my opinion, because I'm seeing it firsthand.
Yeah.
Because we're seeing it from the support side. Where's my K1s from the company? So they didn't even ask the question, has the company issued K1s before? Do you know what you need to do for my particular state? Those are the kind of things that I believe. So I think there's a session there alone that I think we need to talk about. And then the next one is from the issuers, like going through a checklist of items that they need to go through. Because I want it to be thoughtful. Like, I don't want to just have the discussion, which was great with Matt today. And I feel like he's like this onion that we got to unpeel.
Which is that's the thing. There's so many different levels to this. Like, as I'm talking to you, things are going off my head, going, oh, what about that? Should I bring that up? And I'm trying to keep it narrow, but there is tons of.
I know, and that's exactly it. That and the only way we can narrow it is just by focusing on one particular audience and one particular item, so people can grasp it. Otherwise, people go, "Oh, this does not apply to me." Well, if you just heard it a little bit longer, it does apply to you, and that's the thing about rules and regulations and being compliant, is that you need to hear it all out. And I'm at fault with this. I'm the first one here we've discussed real estate before, and we tell people, yeah, you got to do this and you got to do K1's. Okay, great, thank you. It's like a checklist item. And as Matt indicated, and that's what everybody else is doing. And then Matt becomes the checklist, and people go, holy mackerel, this is not a checklist. this is whole. Why didn't anybody tell me this? And that's the preventable. So we're going to be back. We're going to have more discussion. I know, because based on the questions that everybody's asking, and as Kiran indicated, blockchain can handle the K1, of course. But what it's going to do is provide that immutability, the element of the reporting, keeping everyone compliant and making it available to the holders. But we got to get to the source, as always. Is this something a company should be doing? And if it is, to make sure that all the right documentations are there, not just the ones that we kind of handpick one here or there. So want to say thank you to Dr. Kiran Garimella once again for joining me in this time. And then, of course, Matthew John McNally, a partner at Evolve Tax. If anybody wants to get a hold of him, ping us or go to KoreSummit.com, click on speakers. His LinkedIn profile is there. His email address is there. And as well, his firm writes up a blog. So subscribe to their newsletter. Keep yourself updated. I know nobody wants to read about, taxes or anything like that. But you know what? If you're going to be in business and doing this, you better learn everything you can. Till next time, thank you, everyone. Enjoy your great week. Thank you, Matt. We'll talk soon, bud. Be
Thank
good.
you.
Cheers.